Okay, hello, welcome to everyone to our second webinar of the CEPR INSEAD series on FinTech and digital currencies. My name is Antonio Fatás. I'm a professor of economics at INSEAD and a research fellow at CEPR, and I'll be moderating this session together with our two speakers. Now, in our first webinar, we were focused on digital payments. Today, we're gonna have a conversation around technologies that are driving change in financial markets, and in particular, technologies which are associated with a decentralized view of finance. Now, obviously, the most famous technology that fits that definition is blockchain. Blockchain has been around in particular because of its implementation with Bitcoin for a while now, for more than 10 years. And it made a big splash when it started. The word itself became almost a buzzword. It was used in many other implementations in financial markets. It was used outside of financial markets as well. And as with any other buzzword, it became a little bit controversial. There was a lot of discussions. What is it that blockchain has or doesn't? And in fact, if you look around, you might say maybe we're overusing that word a little bit too much. Some of the big blockchain projects that are more visible in finance, whether it's Libra, whether it's the Corda platform that R3 uses, it's not quite a blockchain. And if you look at the white papers, they will admit themselves that they're not using really blocks, they're using something different. And something different is what we more generally call a distributed ledger technology. And that's sort of the title of this webinar. It goes beyond just the example of blockchain. And we want to have a conversation around how those technologies are or are not changing the financial world. Now, we have two speakers with great knowledge on this subject and also experience, which are a mixture of academic experience and policy making. The first speaker is going to be Hanna Halaburda, who's an associate professor of technology operations and statistics at NYU Stern, and she has previously worked as well at the Bank of Canada. And our second speaker will be Raphael Auer, who's the principal economist in the Innovation and the Digital Economy Unit at the Bank for International Settlements in Switzerland. He's also a CEPR fellow and has worked as well on a central bank, in this case, the Swiss National Bank. Now, what I will do is I'm going to give the floor to each of the speakers. They'll speak for about 10 to 12 minutes. And then when they finish, we'll start a Q&A. Questions can be submitted to the Q&A function in Zoom. At any point in time, when you're hearing their presentation, you can already submit questions. I'll do my best to select some of the questions, and I might ask some questions myself as well. So we'll get started with Hanna. Hanna, the floor is yours.
Thank you very much, and thank you for having me here. Let me share my screen. So I will be using DLT and blockchains interchangeably with the caveat that Antonio mentioned that not all DLTs are blockchains, but just it's easier. But when I say blockchain, I generally mean distributed ledger technologies. And like Antonio mentioned, there is a lot of excitement for the use of blockchain and DLTs for finance in different forms. This excitement is in one way or the other driven by the belief that an immutable and decentralized system is desirable because it would prevent fraud and lead to decentralization and democratization of services. The issue is that the blockchain technologies cannot really afford all those properties. And therefore, we need to be careful about which features of the technologies are optimal for financial services and for financial adoption in financial systems. And what do we really expect from them? So let's start with permissionless cryptocurrencies like Bitcoin, the kind of poster child of decentralization in a blockchain. So it kind of turns out that it is not permission cryptocurrencies are not immutable, and they can achieve only limited decentralization in equilibrium. These are known results from the literature, and we also documented in the microeconomics of cryptocurrencies that I co-authored with Guillaume Heringer, Joshua Gans, and Neil Gandal. So just to briefly recap those arguments, why they're not immutable. So the safety of our proof of work blockchain is directly linked to the cost of mining. The cost of mining is the cost of attack. The larger is the cost of mining, the larger is the cost of attack. Now, the value that can be double spent, if the value that can be double spent is larger than the cost of attack, then it is worthwhile for the attacker to attack. And this is why we are saying that the large value payments are not so safe on blockchain, or we need to wait for a really long time. The settlement is only probabilistic, it's not final, because it is not fully immutable. So in fact, the most wasteful cryptocurrencies are the most secure. Wasteful here, we often hear that Bitcoin is requiring so much energy as this country or that country for mining. The more energy it requires, the more costly it is, the safer it is. Now, this costly mining, in fact, is going to also lead to decentralization in equilibrium of those permissionless systems. So mining is costly, it is also risky, and it is costly differently for different miners. So now, because it is risky, we are going to see the drive to mining pools decrease the risk because miners are risk averse. And because it is costly in a different way for different miners, we are going to see cheaper miners who can mine more cheaply, getting larger and larger share of the mining pool. So there are limits to decentralization that are going to happen in those permissionless systems. Moreover, notice how those two forces are playing against each other. If we want to have more secure system, then the cost of mining needs to be larger. But if the cost of mining is larger, it is going to drive more centralization. So it is really difficult to get both in the same time. In fact, as I'm showing you some research with Christoph Müller-Bloch and Yanis Bakos, permissioned blockchains may deliver more decentralization than permissionless blockchains. Not saying that any permission blockchain is going to be better, but we have more control over design in permission blockchains. And there is this common misperception that permissionless blockchains are more decentralized than permissioned. And it may come from this feeling fact that permissionless systems in principle may allow for arbitrary level of decentralization. Anyone can become a miner. Anyone can change and update the code, can propose the changes into the system. But once a permissionless system is live, then there is no really control over decentralization. By design, there is no control. And in equilibrium, we may see increasing centralization that is an effect of this costly participation in the system. So we are going to see centralization in mining as mining is more costly and more risky. And we're going to have more centralization in development because developing software is actually quite costly for the system developers. So updating the systems, it is quite centralized. So we kind of know those reports that Bitcoin's mining, 3 largest miners account for 80% of mining power, and so on and so on. So this is a feature of the equilibrium. This is not a bug. This is something that is going to naturally happen in permissionless systems. Whereas permission systems can guarantee a certain level of decentralization. It is not going to allow for infinite decentralization because there are limits to who can be permissioned. But a permission system, exactly because it is driven by deals outside of the blockchain, it can guarantee a certain level of decentralization. And this level can be higher than whatever is equilibrium in the permissionless system. So, for example, Libra can have contracts or other agreements outside of the blockchain to assure that we have at least 20, 30, 50 validators. Whereas in blockchain, we cannot assure that we are going to have more than 3 or 4. Then it also may turn out that permission blockchains can do better on immutability of the blockchain. So financial transactions often involve mistakes. There would be fat finger transactions, which do happen in cryptocurrencies, in crypto systems, and in regular systems, traditional systems. And there may be mistaken oracles if we are going to go into into smart contracts. Smart contracts are great, but they create a lot of new frictions as well. So immutability may not be so desirable for large-scale financial systems. In fact, if you are thinking about multi-million dollar transactions that cannot be reversed if they are done in a mistaken way, then immutability is a terrible idea. In fact, what we say when we talk about immutability, we want a system that is secure. But at the same time, we want a system that is flexible. And what does it mean that it's flexible? It means that the validators would have possibility and would want to reverse mistaken records. At the same time, it is secure in the sense that it would not be easily possible for them to make changes that are self-serving or abusive. So how can we achieve this secure and flexible system? We argue that it can be done in a permission blockchain with a limited number of known and accountable validators. So we rely on three observations that we kind of see in decentralized systems, distributed systems. So one is, the more validators there are, the more costly it is to change a record in a ledger. And it is true both for permissionless and permission blockchains, and it is true for a good, correct record and for mistake records. Now, at the same time, validators in permission system are subject to external accountability. I'm not saying that in any permission system, but a lot of the permission systems that we are seeing in commercial world will have well-known entities that are validators, and they are accountable to courts, to public opinion, to reputation costs. So there is an accountability that is outside of the blockchain. Whereas in permissionless systems, because everybody is pseudonymous, there is no external accountability. Not only we don't know who they are, but they can change their identity from period to periods. So if they do something that we do not like, we cannot really hold them accountable in any way. The third observation is that validators would kind of abuse the ledger and change good records only if they can get a private gain. So if they can get private gain, they can misappropriate the funds and double spend the funds, then they would change good records. Whereas if they are changing mistaken records, then there is no private gain from doing that. So from these three observations, what we are getting is that in permissionless systems, we are never going to see we are never going to have validators wanting to change mistake records. Why would they do it? They are not going to get private gains. They are not going to get the accountability which holds well-known entities. If they are not going to do something that is socially desirable, they are going to be held accountable. Here, not. But at the same time, if there are lots of validators, and it is costly to change any record, so we are going to see more security and more of this immutability, which is also immutable in a negative way. So we are not fixing mistakes. In permissioned systems, due to accountability, for the same number of validators, even larger payments are safer. So we were saying earlier then that only small enough payments are safe because they need to be smaller than the cost of changing the ledger. But here, the validators need to worry not only about the cost of making changes and succeeding in making changes, they also need to worry about the cost of the accountability cost. Moreover, because of the accountability cost, if there are not too many validators, they will want to change mistaken records. So they will get the flexibility of the system. Why is this the case that not many validators are a condition here? is if there are too many validators, the cost of changing the record, even mistaken record, is so high, then they prefer to take the accountability costs rather than take on the cost of changing the record. So this gives us the result. Finally, let me talk about the premise of decentralization and democratization of financial services. Here we often look towards smart contracts and together with distributed ledger technologies, blockchain, that would allow for decentralization of finance. And we even have the DeFi systems that are built on Ethereum. So would it work? Well, first of all, smart contracts are, I think, a very nice invention, and it's great that we can use them because they allow for automation. But in order to change the landscape, the competitive landscape, they would need to favor small players more than the large players in order to democratize and decentralize the system. While they offer the cost savings due to automation, those cost savings are actually more accessible to large players than small players because there are fixed costs involved. And at the same time, smart contracts do not really offer decentralization of trust, or I would more correctly call it decentralization of risk, in the way that we would like to think. So we would like to think that the financial services will be decentralized if small players can perform the same services at the same cost as large players. But let's think of the insurance example. If you want to make sure that insurance does not need any trust, you need to lock all the potential payout in the escrow of the smart contract. Well, we can already do that. It's just too costly. But if you want to take a little bit of risk, you can do it at the lower cost. But now, if you have a larger insurance company or insurance entity, by aggregating a lot of those insurance contracts, you can have a lower risk and at the same cost. So you are at the better risk cost trade-off. And this is going to be true whether it is a decentralized system like DeFi or whether it is a centralized system like AXA insurance. In fact, what we are seeing in the DeFi insurance applications, they have the same reinsurance pools, and they get the same gains from being larger than small players. And this would work for any financial services with risk where diversification helps. So we don't really see that smart contracts are really helping to decentralize the system in the way that we would really like to see. So going back to the question, would smart contracts allow? I would say not really. With that, let me stop here, and I'm looking forward to Q&A. Thank you.
Okay, thank you, Hanna. We'll pass the floor now to Raphael. Just to make sure, if people want to ask questions, just type them on the Q&A. Do not raise your hand because we're going to use just the Q&A for those questions. I'll read some of that after Raphael finishes. Okay, Raphael, your turn.
Thank you, Antonio. Many thanks for inviting me to speak here with Hanna. I already have to say she gave a very good presentation. I'm going to be very much in line with what she said. Let me share my screen here. So I'll be drawing on both published and ongoing work with my colleagues. Like always, I'll be speaking solely on my own behalf and not on that of the BIS. And I'm going to also be starting on this dichotomy of permissionless versus permissioned. So we really need to distinguish between these two variants that the technology comes in. The first permissionless version is used in Bitcoin and related cryptocurrencies. And these systems are fully anonymous. Anybody can participate without asking for permission. That's where the name comes from. Anybody can act as a record keeper, a so-called miner, provided, of course, that they have access to massive computing power. In contrast, permissioned DLT works similar to today's financial markets. They feature multiple but predetermined and known validators that can process financial transactions. So such systems just merely aim to replace a centralized intermediary with a decentralized network of validators. And I want to examine the potential of these two variants in turn, starting with the permissionless version. In cryptocurrencies like Bitcoin, anybody can update the ledger, recording the ownership of Bitcoin. The difficulty is to deter forgeries of the ledger, which are called majority attacks or double spends. So this is done via what economists call a costly signal. A proof of work is simply a cryptographic proof that someone has invested a massive amount of computing power into an otherwise useless mathematical problem. The miner who presents the solution to this puzzle gets to update the blockchain, and that means they get to add a chunk of new transactions to the chain, and they can collect transaction fees and newly minted Bitcoin, the block subsidy. The system is designed such that the higher the income for miners, the more difficult is the puzzle that needs to be solved. And as a more difficult puzzle is also more costly to forge, it is this what makes Bitcoin safe. In the end, income creates safety. Now we have to say that this system has sustained economic exchange in Bitcoin and other cryptocurrencies, but it comes at a very high cost. A lot of electricity and equipment are being wasted. And importantly, as I examined in my research, this also means that Bitcoin and related cryptocurrencies could function much worse in the years to come. The important point to notice is that of all the income that accrues to miner, only 2% comes from transaction fees, while the other 98% come from increasing supply. As I just said, the supply of Bitcoin is growing with every block added to the blockchain, and these newly minted Bitcoin are paid out to miners. These 98% of miners' income are going to be phased out over the years to come. And with decreasing miner income, the payment security of Bitcoin is set to decrease substantially. In my research, I also document that the transaction market is ill-designed to take over in providing this income. And as a result, those who want to trade Bitcoin in future years will have to wait longer and longer until they can safely assume that a payment is irreversible. Eventually, this could even take months. I want to conclude my discussion of the permissionless DLT by pointing out that these are not like mere theoretical considerations. An increasing number of smaller cryptocurrencies already has fallen victim to attacks, and many investors lost their funds. So here you can see a timeline of recent attacks. As time progresses, the industry will have to sort of institutionalize in some sort to counter these developments. And institutionalization brings me to a very different variant of DLT, the permissioned one. It's very similar to a traditional marketplace operated by a known and legally liable central intermediary, except that in permission DLT, this one central intermediary is replaced by multiple ones, so-called validators. And just like the job of today's central intermediary, the job of these validators in permission DLT is twofold. On the one side, they need to examine income and transactions and check whether they are legitimate. On the other side, the validators need to update the ledger honestly. That means they need to record all transactions that actually occurred, and they must not record any other ones. Now, this market design to replace a known central intermediary with many known validators is now being explored in a variety of settings. This includes CBDC, stablecoins, trade finance solutions. Also, the possibility for novel forms of regulation and supervision has been considered. But is it a magical bullet? In ongoing research with Cyril Monet of the University of Bern and Hyunsung Shin from the BS, we argue that the mere fact that decisions are decentralized does not mean anything, because the goal is not a specific market structure. It is to ensure that honest transactions are always processed and that no other transactions are processed. So we need to examine the incentives of the validators in doing just that. And what we do is we formalize validators' incentives to, on the one side, free ride instead of verifying transactions, and on the other side, to validate dishonestly, i.e. ignore some transactions, just as in a double spend attack in a cryptocurrency. Technically, how we do this is we model validators' incentives in a public good contribution game a so-called global game. And we uncover two basic forces. On the one side, there is a fundamental case for decentralization via DLT, as good governance requires many validators with high stakes in the system. So the intuition here is that validators can participate in the market themselves also as users, as those who want to transact on the ledger. If they misbehave, they not only lose their right as validators, but also access to the marketplace as a user. We find that because having many who could lose access makes it easier to disincentivize dishonest behavior, it is generally optimal to have more than one validator. However, there's a counterforce. For having multiple validators introduces the need to coordinate their efforts. If there is one validator, the incentives are easy, and the one validator can collect transaction fees only if she does her job correctly. If there are many, a free riding problem arises, and each validator needs to face incentives so that she contributes her part to delivering a public good, which is contribution to consensus. So the optimal design of DLT balances these two forces. We show that such an optimal design may make for a system that is more efficient than a centralized intermediary, but this is true only under specific circumstances. So this brings me to the conclusion of my initial remarks. We need to distinguish between the type of DLT. As Eric Budish wrote, the economics of cryptocurrencies is very limited. As we are investigating in ongoing research, the permission variant may have promise. In this, we need to be very careful. The technology is infant, and expectations are simply too high. DLT may bring subtle efficiency gains, but this is true only under specific circumstances and if the technological implementations are solid. I think only time will really tell whether this technology will be part of the evolution of financial markets. So this concludes.
Okay, thank you, Raphael. Let me start with the Q&A section of the session. I'm going to pick on a couple of questions that I see on the Q&A, but it also links to a question that I wanted to ask myself. I find it interesting that in the last year, many of us have spent a lot of time trying to understand how databases work, trying to understand how different databases deliver different outcomes. And this is unusual. For many years, those of us who've done work on anything that has to do with financial markets, we never talked about databases. We talked about outcomes, we talked about incentives, but we didn't think too hard about the technology. Now, what is it? What is it about these new technologies that we are so focused on sort of the inner working of these databases as opposed to questions which are at a higher level? And here is where two of the questions on the Q&A are related to this statement. How different is the discussion we're having on these systems from discussions we could be having around the current systems that central banks or banks use to manage finance? What is it? What is it that has made this discussion much more based on the technology and the governance than on the outcomes or the other things that we used to discuss before? I know it's a general question, but I think it matches well sometimes the skepticism that exists with sort of labels and technologies. Is it really completely different, or is it just a variation of something we've been using already for a while? I don't know who wants to take the question first.
Hanna, you want to go first?
I can do it. So I think we have always been looking at how technology is affecting outcomes. And in some cases it is clear, and then we can just skip the technology part. And in some cases it is not. So I have done a lot of work on the platforms and platform competition before. And there is a big question of how technology is affecting the outcomes in the market. How the fact that we have internet on mobiles is affecting the outcomes in the market. So I would disagree. Maybe we haven't, information systems people and economists, strategists, central bankers were not looking so carefully into databases in particular, but we have always looked into how technology is changing incentives and outcomes. So here, what happens is that we have this premise of decentralization, and we look at the one example of blockchain, which is Bitcoin, and the first instinct was, let's do what Bitcoin does in other environments, in other scenarios. And only by looking at the technology of how Bitcoin does what it does, we can realize that it doesn't travel so well, that we can't really reuse it so directly in other contexts. So the first discussion of blockchain was, oh, let's just do the same blockchain for Bitcoin. Let's just do something else than Bitcoin. But then you're changing incentives of miners. Now you are not rewarding them with Bitcoins. Now there is no mining, or they don't want to mine. So what does it happen? So there is this premise. We started with this premise of how, what if we could do it without any central parties? And also in some contexts, it sounds like a good idea. And in others, we need to think whether this is really a good idea. How did we end up with central parties? So I think that it is actually quite natural thing for new technology that we're looking at the technology capabilities to check how it affects the outcomes in the market and what we can do with it.
Yeah, I again want to mirror that in a sense, right? There are these two developments. One is a salient trend towards more digitization, the rise of smartphones, platform economy, big tech. That's a big game changer, right? That affects every aspect of our life, including just now. It doesn't have to do anything with money in the first place, but 10 years ago, this thing called Bitcoin came about, and it attracted a massive amount of attention, right? And then 2 years ago, we saw how a big tech firm started thinking about how it could combine that with its technology and its user base and make for a new payment system. And so these are developments that sort of, on the one side, we have real developments that affect our daily life. And there are others that merely created a lot of attention, in my view, on like how payments function, how they could change with technology. And I think it's this interaction of these two trends of why we're all looking into these technologies. And I think, having also followed this actually not as long as Hanna, who's very early for an economist, like starting in probably 2014 or something. You need to correct that. But I've looked at it a little bit later, but early for a central banker. And I also saw these reflexes. Oh, there is Bitcoin, and people still had sky high expectations, and then thinking about how this actually could be applied in other contexts. And the truth is it can't be, because it achieves something like exchange that is extremely inefficient, but works between parties that don't trust each other at all. Right now, this is not how we think money and finance generally works. It may work in a legal context. So, right. So, but now we look into further aspects. We look into smart contracts that, again, right, they're not inherently connected to distributed ledger technology or Bitcoin, right? It's just about how we can sort of create certain commitments via technology, certain automation in settlement, and there are changes. I think these changes are much subtler. Also, the sort of the incentives of the players in markets could change, and it's about understanding these subtle changes and what else can go wrong in these new technologies. And a lot can go wrong, and I think this is sort of why everybody's looking into this, because there will be an evolution. There will be elements. It won't be these elements that we focused on initially.
Let me do a follow-up. Yeah, go ahead.
Yeah. So I kind of wanted to go a step further and answer the question, what is special about blockchain technology? And I think that the blockchain technology kind of affords us, or at least promises, but I think it really affords us better, more efficient collaboration between independent parties that are not necessarily accountable to one boss. So we had distributed systems for a very, very long time. Any, inventory system in your department store where they can tell you that the shirt that you are looking for is not available here, but if you go to another location, they will have it. This is a distributed system. Dropbox is a distributed system. But so we had it for a long time. But how to get an independent parties that cannot be that cannot be governed by the same hierarchy, how to get them collaborate and work within and coordinate within the same system, and for example validate records. This is a new thing. And it turns out that this is not such a new thing in theory of computer science, because we had theorems about the Byzantine tolerant systems for a very long time, but it was never done in practice. And Bitcoin catalyzed those developments. So in some sense, there's a lot of the things that we already had, but we didn't use. And now we are using. This is the new thing.
Thank you. Let me pick on a couple of questions on the Q&A, which are a little bit about sort of the future of Bitcoin. I mean, some of the statements you made about permissionless systems were sort of on the pessimistic side. So there's a question about what would happen when the rewards go to zero. I mean, does it mean the end of Bitcoin? And then there's a couple of questions asking whether some of the alternative sort of like consensus or validation mechanisms could rescue Bitcoin. It might not be proof of work, but maybe it's one of the others. Any particular view on the future of Bitcoin, given some of the content of your previous slides? Maybe Raphael, do you want to start?
Yes. So as I said, I think it's a fundamental problem. I've written a column on this and presented it at a large crypto conference, and I called it the security trilemma. So Bitcoin can go in one of three directions. It could either keep generating income by expand supply, but that is obviously right. That undermines the fundamental value proposition. Then you would have more Bitcoin than initially promised. That's technically possible. People just need to coordinate that, but it's not likely. It's a theoretical possibility. Another aspect is it could sort of change the transaction market. For example, we saw one instance in the history of Bitcoin where actually transaction income was very high, and that was during the market frenzy of late 2017. But then sort of this involves a huge compromise, because basically the system is designed such that it can only generate income once there's really congestion and people want to get ahead of the queue and start bidding it up, the fees. So then you would basically have to fine-tune the block size all the time to sort of generate this income. That could be right, or generally play around with the transaction market. That is the second set of options. And then the third, which I call some form of institutionalization. And that's important because there's a lot of proposals. There is proof of stake, but we need to be aware, right, that proof of stake has solved some problems, but it doesn't solve other problems, which are called so-called long-run attacks. And so even like, you know, proponents of some cryptocurrencies that are rapidly advancing, they admit that there is some soft form of institutionalization there, in a sense that you need to have, if you're a newcomer to the system, you need to trust somebody who points you to the correct system, because there could be multiple versions floating around. There are also other considerations. For example, what if the miners, we've heard from Hanna's talk that there is this natural tendency for a few large players. What if they form an oligopoly and just say, look, we'll just, even if somebody attacks us, we'll just ignore this attack and we'll just keep. But then it's an institutionalization, right? You need to trust these 3-4 players that they're not kicking out certain transactions. So, and then you might ask yourself, well, why don't we institutional it for sure then, right? But via legal systems, and say, well, the fundamental, it's very different now. The fundamental value is that we've coordinated on this strange unit Bitcoin where there are 21 million, and we accept it and we shove it around in regulated exchange. So, right, there is a range of how Bitcoin could change. And I feel this realistic basket involves institutionalization, even though if people don't call it that, right? Because proof of stake is some form of institutionalization, and like mining cartels or retaliation attacks, as they are called, it's also some form of institutionalization. And the question I have as a person coming from institutional finance is, well, how different is that whole thing then in the end once it works in the long run?
Well, I would say that it's different because it's institutionalization without accountability.
Okay.
It may be even worse, right? You end up with 3 miners or 3 stakeholders, but you don't know who they are.
But in my preferred world, one would know them. But you're right; it could even be.
And I focused on in my presentation. I focused only on proof of work, but the research takes into account other consensus mechanisms. Proof of work is the only so far that is proven to be decentralized to a larger extent. Proof of stake has its own problems. So far we did not find a way that is preventing long-range attacks without checkpoints. Checkpoints are a form of centralization. The nothing at stake problem, and all the other systems proposed consensus mechanisms have some sort of problems and have not been proven to the same extent as proof of work. So this is why when we are looking for a very fully decentralized system, proof of work is the one that I would anchor. But a lot of the criticism also goes true for proof of stake and other consensus mechanisms.
Thank you. I'm going to raise the last question, which might also be a big one, but there's a few questions about sort of like what is going to work going forward. People are trying to look for the cases that are going to be successful. Now, I think both of you put a lot of emphasis on permissioned DLTs. So you sort of look at the weaknesses of permissionless, and you sort of put more emphasis on how to build the right incentives on permissioned DLTs. Now, what are the areas in financial markets, where we're more likely to see these things coming out in the next year in a successful manner, not just as pilots, but something that replaces or creates a completely different interaction between players in financial markets?
Hanna, you want to go first, or should?
So I see. So, for example, one of it's not core of financial markets, but supply chain, and therefore what goes after as trade finance seems to have proven quite well so far that permission blockchains are kind of working. So IBM and Corda systems, they seem to be more promising than other systems that I have seen. Now, that does not mean that we are not going to see more developments, but these are the most optimistic ones I've seen so far.
I want to be careful, because he said in the next year, and I don't think we'll see much in the next year. I would be a bit more medium term, but I think, and I can tell you what the BIS Innovation Hub is working on. And they're looking into trade finance. That's the Hong Kong center of the BIS Innovation Hub. So that there I would perfectly agree with Hanna that we're seeing something. Another project is that's the Swiss center of the BIS Innovation Hub, together with the Swiss National Bank, and they're looking into a wholesale CBDC. And right, obviously we're talking about an official marketplace that is trading in a regulated environment, so it's a permission system, and it turns out, right, that these are systems that technologically already they're starting to take shape, but then market design questions have actually come to the fore. In a question is like, when you go to like a certain settlement cycle, the liquidity in these systems is completely different. And so I think it's going to be very interesting. We're going to see something like this launched all over, I guess, in a couple of sandbox environments. But we still need to understand here how liquidity will interact with technology. And that's what it makes it so interesting. It's first technology that makes things a little bit different, and then the economics changes a lot. And so everything needs to find a new equilibrium. And people probably also have in mind retail CBDC. Here, I mean, we just did a stock take that's published in a BIS working paper. And most CBDC prototypes are actually based on DLT more than on conventional systems. But it's, you know, these systems couldn't scale yet. So we couldn't see them in production in the current technology. We don't know that. People, but I can tell you the one thing that we find is that people at current tend to try actually DLT in retail CBDC.
Okay, thank you very much for your answers. With 2 minutes past our time, there's plenty of questions that we got that we don't have the time to answer, but I guess it's a topic that raises many questions. I would like to thank our 2 speakers, Hanna and Raphael. That was a great conversation. And obviously all the participants. In a couple of weeks, we'll have our 3rd webinar in this series. So please stay tuned and you will hear the speakers and the exact time and date. Okay, thank you very much to everyone. Bye-bye.
Thank you very much. Bye-bye.